I welcome you back to Module 20. Can you believe we've actually been through 19 modules? I mean, it only seems like we've been through 17, but anyway, Module 20 of the Series 6566 by Series 7 Specialists. Be sure to go on our website, let us know what you think and ways that you think we can improve. Really appreciate that, and we hope that we're being of a good service to you. We hope you'll tell others about it, especially the folks in your training department. We really want to be, we're not trying to displace anyone. We want to be a good supplemental resource to your training department. Of course, if you don't have a training department or if you don't have access to a class, it's my pleasure to provide that primary resource. But we understand that we're going to be a backup resource, a secondary resource in a lot of cases, especially with your large wirehouse firms. But tell them about it. Make sure that they know that it's there. And we really appreciate being able to be of service. All right, we promised that we'd go into zero coupon bonds and start talking about them. And so let's go ahead and do that at this time. Zero coupons can be corporates, treasuries, municipals. Like I say, any issuer can issue a zero coupon bond. They're purchased at a discount to their par value. So let's go ahead and just graph it out because, like I say, that's what we've got. They pay absolutely positively no interest as they go. Thus the term zero coupon. Let's read it backwards. You know, reading terms backwards tell us how it works. This has a coupon rate or a payment rate, a current interest rate that's paid in cash of 0%. So it's going to pay. Technically what they do is they write me out a check every 6 months for $0.00. But there's no reason to waste the paper, so it just doesn't pay. Anything. All right, so anyway, here's the deal. Those things are going to mature at $1,000 some point in the future, okay? So that's what they're going to be worth. All right, there, try to at least get it on the crosshairs. There we go. But the thing is, since it's not going to be paying anything, then the way I've got to get from point A to point B is for point A to be less than the maturity value. So I'll buy it here, and then actually it takes a nice little exponential curve like so, because you do have a compounded rate of return built in to where it's worth $1,000 at maturity. Okay? That's the way that it works. Now you'll notice that we have several terms that are on these things. So it's purchased at a discount. That is the present value of $1,000 at X%, okay, over this time period. Okay? So that's the present value. We'll take the $1,000, discount it back by that percent over that time, and we get to the present value. It matures at par, which par is the future value. In other words, if I take it, this is just a mirror image. If I take this much money and compound it up at X% over this time period, I'm going to wind up with that much. That's my future value, compounded over that time at X%. It has a true compounded yield to maturity. In other words, this rate is its internal rate of return. All right. So let's see. Then I think we have a couple of other things here that, but there's one other that we'll go ahead and cover now, and that way it'll be reviewed when we get to quantitative analysis. Is that with zero coupons in particular, this is its duration. Now, duration is measured in years and months, okay? It's not the same as maturity, except in the case of zero coupons. And in the case of zero coupons, the duration is equal to the maturity. Now, any time that any bond pays me anything, it's going to shorten up the duration, because it's going to shorten up the amount of time that it takes me to get all my money back. Okay? So like I said, but on zero coupons, it's going to take all the way out to maturity before I get my $1,000 back. So maturity and duration on zero coupons are exactly the same thing. Now, duration actually is a good measure of volatility for a portfolio of bonds. And if this is the longest possible duration is on a zero coupon, then my largest volatility is going to be with zero coupons. Because what you've got is a situation where in industrial applications, a lot of times they measure pressure. And sometimes you get spikes of pressure, okay? And what they'll do a lot of times to minimize those spikes in pressure is that they'll take their pressure gauge and they'll fill it up with glycerin. Well, you know, glycerin's real gooey and thick. And so if you get a spike, then what happens is it tries to do that, but it just can't do it, okay? So, because it's full of glycerin. Now, if you start dropping the glycerin down, then what happens, it has a little bit easier to move, and finally you get no glycerin, the thing just all over the board. That glycerin is the amount of money that it pays to us on a current basis. This pays zero, a zero coupon bond. So if the glycerin are way the heck down here, now you start throwing out big coupon rates, and that's going to dampen out that volatility, just like the glycerin and the gauge will dampen the volatility of that needle, okay? So, like I said, current payments will dampen our price volatility. This has no current payments. This has huge price volatility compared to all other bonds of same maturity. So, therefore, it has the greatest maturity. So, highest volatility or duration among bonds with the same maturity and duration are exactly the same thing. Okay, going into cash equivalents, we have treasury bills, which are a risk-free benchmark. All right, if you'll see some of the quantitative analysis tools that talk about risk-free money, use a 90-day T-bill. Okay, if you and actually, that's going to be like I said, the rate that's used for a risk-free benchmark. So I could, like I say, put my money into a 90-day T-bill, and it's a 3-month bill, and just be, like I said, I'd get my money back in about 3 months. And it's so anyway, we'll do that. You have negotiable CDs. Negotiable CDs are over $100,000. All right, and they, quite unlike the little $5,000, $10,000 CDs that you get down at the bank, where they say there's a significant penalty for early withdrawal, you don't withdraw them at all. You sell them to somebody else. Now, if interest rates have gone up, your price is going to go down some relative to what you would calculate that you'd get. But if interest rates go down, prices actually could go up. You can get more than you'd counted on. But they're negotiable CDs. Like I say, you just you negotiate a price between the two of you and make a trade. Money market funds, very important to remember, they're not FDIC insured. But they will buy treasuries, they'll buy the negotiable CDs, they'll buy commercial paper, they'll buy bankers, all these short-term instruments. You put them into a mutual fund, and that's what we have. Now, all of them are going to have low yields because there's just not a lot of risk associated with them. You're going to get your risk back. If it's not good quality, it's just not going to hit the marketplace. In fact, we talked about that with commercial paper, that only the top 2 grades get out of the marketplace. Nobody's going to buy the other stuff. Okay, so anyway, offer low yields, but safety and liquidity. Safety and liquidity. Man, those are the watchwords. Now, you're very likely to see a question that says that Mrs. Brown has $800,000 from something, I don't know. And it goes through this long story about what her ultimate goals are and this and that and whatnot. You know, she wants to paint on Cape Cod, all kinds of junk that they throw in the question. But then it says that she's planning on buying a house in 4 months, 6 months, 8 months. What's the best investment for her? Money market fund. Cash equivalents. Why? She's only got 6 to 8 months, for crying out loud. She can't take that kind of volatility. Remember, we said that the market doesn't respect your need for cash? and it's very likely to do that just on the day that you need cash. Put it in something that's going to give you safety, liquidity. Yeah, you get a low yield, but you know what? It's there. You can get it. Boom. And a lot of these things have check writing privileges. So cash equivalents, money market funds, you'll see a question like that. Watch out for that little kicker that says, hey, I'm going to need it here really quick. And make it liquid, accessible, very safe. Money market funds. Okay, some of the trading terminology that we have on these securities. Let's see, we have an exchange. An exchange is a centralized marketplace where you have auction-based transactions, agency transactions on which you pay commissions. And so, again, technology has changed a lot of things. And one of the things that's changed is the relative efficiency of marketplaces. They've all improved. They're all better now than they were even 15, 20 years ago, but certainly 50, 60 years ago. It's just incredible the difference in market efficiency, where we can get orders off at fair prices very quickly in large volume. And in fact, that's the way we're able to handle that kind of volume, is through technology and automation. But in any event, in an exchange environment, everybody comes to the same environment. They come to the same place. There's a physical building. You know, unfortunately, terrorists and stuff like that, you can't really visit the exchanges anymore. You used to be able to go out, look at them, okay? Watch the trading going on. But in any event, it's a physical place where they have auctions, and everybody who wants to buy or sell comes to the auctions. Now, is that technically true anymore? No, but it's okay. Go with the flow. Just don't argue with your test question, okay? Don't get picky about, yeah, but there are things that happen off the trade. It's fine. Just let them happen. We'll just, just go with the flow. Now, because of the fact that I can't get on the floor of the exchange myself, I have to ask someone to take care of that for me. And the thing is, they take my stock and act as my agent. Oh, let's see, what we say, broker, dealer, and a broker acts in agency transactions, just like the real estate broker, and the contract says they'll pay a commission of X%. So all those terms go together with the exchanges. That's where you see those agency transactions taking place. Over the counter, or OTC, you have a dealer-to-dealer marketplace. All right, so I'm merchant to merchant, basically. You have negotiated transactions. Now, there's not a whole lot of negotiation goes on these days. Okay, I mean, you put your price out there, and the computers look at it, they see it, and they take it, and it's a done deal. But in its purest form, I think 60, 70, 80 years ago, there were actual negotiations that went on for these transactions. They're principal transactions, because we're dealing with merchants. What is the counter? It's like the counter at the checkout stand. Okay? You say what you want, and the merchant gets it for you, puts it on the counter, you pay for it. What did he do? He bought it at wholesale, marked it up, sold it at retail. And the same thing happens. You bring in your stuff you don't want anymore, you pop it up there, he pays you a discounted or marked down price and puts it on his shelf, puts the retail price on it. It's exactly the same thing. And so you have negotiated transactions, principal transactions, characterized by markups and markdowns. That's a dealer. Okay, a bid is the wholesale price. You always bid for something that you don't own. And so think of it from the dealer's point of view. You bring your stuff and put it on the counter, what's the dealer going to do? He's going to give you a bid. This is how much I'll pay for it. Then what's he going to do? He's going to put it up on his shelf, put a price tag on it. That's his asking price. That's the retail price. How much money does he make? It's the difference between the bid when it was here and the ask when it was on the shelf. That's the spread. Spread always means difference, in this case between the wholesale and the retail price, because we got a merchant. So the bid, wholesale price, ask or offer is the retail price. They'll sell to the public. That's where the public buys. And really, would you expect anything different? Because if you have something to sell, you're going to have to leave a little bit of juice in it for the merchant so they can make some money. And who do they make it from? They make it from the next guy they sell it to. You're going to pay retail price. You're going to pay that asking price if you are a member of the public. You have firm quotes. Those can be relied on for an execution at that price and at that size. You probably won't get into that on this test, but if I'm a dealer and I offer something, or I'm asking X number of dollars and cents, and I say that I'm firm on that for 500 shares, I have to honor 500 shares. If I don't put anything, it's assumed I've got 100 shares. So put 1,000 shares, I got to honor 1,000. That's a firm quote. Subject quotes of various types, they're subject to change. They're subject to prior sale, subject to all kinds of different things. They can't be relied on. It's a working estimate, I guess is the best thing to say. I mean, you've done it. You've been at a home show and you've seen the concrete contractor, and you say, hey, I'd like to have a patio out back. I got pretty reasonable access to it. So I think you can bring the truck right around back, and I want one about 14 by 20. God, how much is that going to run me? What are they going to say? Well, we got to look at it, which they do. Okay. But it's going to be about this much a foot. So that's a subject quote. Now, once they come out and they see, they'll give you a proposal. That's a firm quote. Okay. But it's the same thing. Exactly the same thing. It's just that it's a different environment. That's all it is. Broker-dealers, we've talked about this before. They effect transactions in securities for customers on behalf of the customers as brokers or agents, or for their own account and risk as dealers, basically merchants. All right, so then you have specialists who, out on the exchanges, they're dealers on the exchange. They maintain a fair and orderly market on exchanges, so that, like I say, if they have to eat something because there's just an influx of orders, either buy some to stabilize out the market or sell some of their own inventory to stabilize the market, they'll do so. But their main job is maintaining a fair and orderly market, not one that does not move, just one that moves in a fair and orderly fashion. And then you also have market makers. These are your merchants. They'll maintain inventory in OTC securities to facilitate trading. That's why we've got such good liquidity, is that in order to be a merchant in this that they want to, they've got to be merchant in these other things too, that maybe they don't necessarily want to maintain a marketplace, but they have to provide liquidity for the overall market. So like I say, those are our market makers. Basically, again, the merchants when it comes to securities in the over-the-counter market. A market order is to be filled as soon as possible. Best price available. Now here the transaction is guaranteed, but the price is not. So basically you say, look, Dan, go down to the grocery store and get me a Heath bar. You're going to get a Heath bar. Okay, I don't know if it's going to be $1.29. I don't know if it's going to be 89 cents. I don't know if it's going to be $2.50. But whatever it is, when I give you the Heath bar, that's what you're going to owe me. You'll get the candy bar. I just don't know what the price is going to be. Or you could have a limit order. A limit order says, Dan, I'm willing to pay up to $1.40 for a Heath bar. So go out, and I go to the store, I look, Heath bars are $1.29. I'll get you one. Cool. They're $1.40. I'll get you one. They're $1.52. I ain't getting a Heath bar. It's too much money. And the same thing on the flip side when you sell something. Okay, I need at least this much money. And so, like I said, that's a limit order. You may or may not get a transaction. But if you do get a transaction, the transaction price will be at worst the limit that you put on it. Like I say, if I can get you better, if I can get you $1.29 when your limit's $1.40, I'll do it. Yeah, that's cool. But like I say, you may or may not get your order filled on a limit order. And then a stop order is upside down on a limit order. Basically what we want to do is we want to stop a loss, or we want to protect a profit. And so it's kind of, you can look at it either way, either from a stock that's going down or a stock that's going up, okay? What you do if you're on the buy side is that you put in a limit order if you say the stock's at 60 and I want to pick it up, it gets to 55. Because I'll pay 55 or less, but I'm not going to pay any more than that. However, if the stock's at 60, and here's what it's done. It's gone to 60, and then to 60, and then to 60, and to 60, and to 60, and it's fallen back and fallen back and fallen back every time you say, I'm not going to tie up my money on this thing until it shows me that it's going to do something. So I want to put a buy stop order when it goes to 60, and then 61, and it hits 62, it's pretty well committed. I think it's going to go ahead and continue from there. So I have a buy stop order there. Okay. The flip side, the sell stop. If it's at 60, I say, here's what it's done. Going to 60, going to 60, going to 60. And one of these days I think it's going to go up and go like that. But just in case, if it ever breaks down and goes to 58, then it could easily wind up at 45. I don't want to take that risk. So sell me out only if it goes down. And then, like I say, stop my loss at 58. So a stop order, like I say, it's kind of the mirror image of a limit order. A short sale is where I borrow something and I sell it. And I hope that it's going to go down in price. Because, the old adage, buy low and sell high. That's exactly what you want to do with a short sale. You just want to do it in reverse sequence. Let me show you. You've got a stock that you're looking at the chart because, see, these things are typically short term. So we're going to look at technical analysis for trading or timing. And one of the things we're going to look for is, here's the chart of the stock. Okay? And also, let's see, it does this, it does that, and does so. Look at that, look at that. Little head and shoulders top, right? So if it breaks down past that, that's a very bearish signal. What we might want to do is to put in an order right there, a stop order to sell the stock short. We'll borrow it from someone else, and the broker-dealer has to, in fact, document that they have located stock that they can deliver to the buyer. And if it goes down in price, then what we'll do, we actually sell it up here and buy it back in down here. Well, the thing is, look at it this way. If we had bought it here and it had gone up and we had sold it right there, we would have made that much money. Well, that's what we did, except that we sold it first. And then went down and we bought it back. That's a short sale. That's what we want to happen. The problem with short sales is that if, let's say that we put in our little sell short stop order right there, but it decides, oop, we're going to fake you out, and boom, and it goes up, and the next day it doubles. Yeah, we have unlimited risk potential because that thing can run away from us forever. That's why we probably want to put a buy stop order right here. Protect ourselves from a big loss. In fact, as it went down, we might want to put a buy stop right there, and then right there, and then right there. Protect that profit, notch down that profit as it goes down. So that's a short sale. Like I say, it's unlimited risk potential. You're going to have to buy it back in someday. You hope to buy it back in at a lower price. A day order, so what it says is an order for today. Fill it today, or else at the close of business, if it hadn't filled, just cancel it. Okay. An open or GTC, good till canceled order, that is in fact good until it is in fact canceled. Yes, different broker-dealers have different policies on this. This is not a different broker-dealer policy test. This is the rules test. The rules say that as long as you reconfirm it in April and October, okay, then end of April, end of October, then it will remain in effect as long as you want it to. All right, then a cash account, all securities are fully paid. And in a margin account, though, we can actually borrow money. Let's go ahead and go through that, and then we'll come back and take a little break. With margin, a customer can borrow from the broker-dealer to introduce leverage, so that if I buy $100,000 worth of stuff and put $100,000 on it, like in a cash account. If it goes up to 120, I've made 20%. But if I borrow 50 and put 50 of my own, and it makes the same $20,000 move, I've made 20%, $20,000 on only 50,000 of my money. That's 40% return on my money. That's leverage. But the flip side of that also applies, because margin accounts introduce leverage that can hurt you if the market goes against you. Okay? Because of that, it's not suitable for fiduciary accounts. UGMA accounts, Uniform Gift to Minors Act, UTMA, Uniform Transfer to Minors, what have you. It's prohibited by law for investment companies and retirement plans. All right, and then typically it violates the prudent investor rule for fiduciary accounts because of that leverage on the downside. All right, so you have the risk of incurring maintenance calls, which basically maintenance calls, you got to deposit more money or stuff, and you got to do it like right now, in case the market moves against you. So all of those would make it unsuitable for those types of accounts, fiduciary accounts, retirement accounts, minors, etc. All right, well, let's go ahead and take a break here. We'll come back then and pick up talking about some of the other accounts and the types of investments that we have, and we'll see you back after the break.